for Levenson Attorneys at Law. Mr. Browndorf has practiced exclusively in banking, creditors' rights, bankruptcy, and commercial litigation since 1984. It is our pleasure to turn the webinar over to Mr. Browndorf. Mr. Browndorf, the floor is yours. Thank you.
Thank you, Michael, and thank you to the Chamber for giving us the opportunity to educate our client base and the South Jersey community, particularly the small business community, on the CARES Act and on what to do subsequent to the CARES Act. I'm very pleased to advise you that we have a full plate of very talented speakers today. We have Jarad Stiles, who is a senior member of our small business group, and he is also a member of our tax group. His primary focus will be on the new developments in the PPP. We also have our newest partner, Will Rubley. Will Rubley will be talking about what to do now, what happens after the riots are over, what happens after PPP is over and exhausted, and what happens when that Labor Day comes. What are we going to do? In addition, we have a new young associate, Ed Corma. He is an associate in our restructuring and bankruptcy department. He will be speaking about small business bankruptcy, which is a brand new section, which we're all going to learn all about. That is perfect for a small business, gives us a lot of leverage as to where we're going. So our first topic today is going to be the CARES Act. For those of you who have not seen a webinar and are not familiar with this, there may be one or two out of 300 million people that don't know generally what it's about. I'll take 1 minute and then I'll turn it over to Jarad to give you more detail on the changes. Generally, the CARES Act is a stimulus bill, and it's designed to keep the stock market up. It's designed to keep the economy going. It's designed to allow us to survive being locked down in our homes and not generating income. The PPP portion of it is really fairly straightforward, even though it's built on sand and it changes on a daily basis. We laugh and say that the typical maxim of the only thing constant is change when it comes to the PPP. Generally speaking, it was designed to allow small businesses to retain their employees, despite the fact that they don't have any income to pay the employees. And the calculations were generally, you take 2.5 times your average monthly payroll, and you get that as a loan from the bank. The bank then gets an SBA guarantee if you do everything correctly and you use those funds. Again, and from a general perspective on a small amount of your operating expenses and on your payroll to achieve the goal of the PPP, you get it forgiven. Forgiven means specifically that the SBA pays back your loan and you don't have to pay it back. Again, the only thing constant here is change. Everything has changed with respect to calculating how much money you can get. Doesn't matter an awful lot if you're in the middle of Tennessee, but one of the changes that Jarad is going to speak about is critical to us South Jersey small businesses, because the change relates to seasonality and relates to how you calculate how much you're going to get. In addition, there's been major and significant changes that have happened within the last 72 hours with respect to forgiveness, which will have a dramatic impact upon solving the #1 problem that I personally had, and many of us professionals that are living in this area had with the PPP. The problem with the PPP was, okay, you got to take it, and you got to take it on this day. Well, my business isn't open. So it's terrific that you're taking care of my employees and you're putting me in a position to pay to keep my payroll, but the payroll isn't producing any revenue. So there was an 8-week restriction. You had to consume that in the first 8 weeks. It resulted in some creative stuff by Jarad and people like Jarad to get around some of it and to be able to still comply with it, but be able to consume it and still produce revenues. But Jarad will talk about those changes, which are significant. Without further ado, Jarad.
Yes. Good morning, everyone. So there are a couple of changes that are quite dramatic in nature due to the PPP Flexibility Act that passed last Friday. at which time President Trump signed it into law. There was debate between both houses, but ultimately the House passed it, I believe, 417 to 1, and the Senate unanimously approved this bill. Now, what it does is it stretches the forgiveness period from 8 weeks to 24 weeks. Well, what does that mean? That means that there's a lot more creative things that we can do to consume everything in due course. So what do I mean by that? I mean that some of the strategies we previously employed to make sure we utilize the funds over 8 weeks are no longer necessary. And in fact, we can get a larger return for certain businesses if we employ alternative methods of both payment as well as opening procedures. Not all businesses are open right now. And when we talk about the Atlantic City area, the casinos still aren't open. So even if they were open, we're not going to be anywhere near the same capacity we otherwise would have just in terms of foot traffic within the city itself. Okay. So what are the big takeaways from the PPP Flexibility Act? Well, other than extending it from 8 to 24 weeks, and again, look, you're still subject to a lot of restrictions in terms of how you can spend the money. Just because you receive the money doesn't mean that you can use it in due course for working capital and other things and have it forgiven. It's very important to document exactly where the money is going, because failing to do so, you know, if I'm a restaurant, for example, and I need oysters and I use the PPP money for oysters, then I'm not going to have any of that money forgiven. It's taken out as a loan. Now the loan is at 1%. It was increased to a 5-year as opposed to a 2-year repayment, but I'm going to have to pay back every dollar. Your goal should ultimately be to pay back $0 and achieve maximum forgiveness. This is going to depend on a case-by-case basis on how to achieve this ultimately, but with the work of your accounting professionals and legal professionals, we feel that the majority of people are going to be able to get the bulk of their PPP funds forgiven. I know we have repeatedly stated in the past that if you have not received PPP funding, it's going to run out. Well, I'm going to reiterate that if you have not received PPP funding at this time, it's going to run out soon and you should apply. Honestly, we believed that the funding would have run out some time ago, but because everyone was given certain news information, a lot of people turned the money back in. Because they turned that money back in, there's more money out there. Although, in my experience, we've seen more PPP applications now than ever before. It's just they are for smaller amounts. We're no longer seeing the multi-million-dollar PPP loan applications. They're still out there and we still are doing them. But we're seeing a lot more PPP loans between $20,000 and $100,000. And that, if anyone wanted to give me $100,000 or even $20,000 that is ultimately forgivable, I would take it every single day of the week. I cannot emphasize enough, this is the greatest cash giveaway in American history. Because everything that they have done, and by they, I mean the SBA and the federal government, has been to make forgiveness more achievable for all relevant parties. Every change and every interpretation they have done has made it so that more money could be taken out and more money could be forgiven. There are some complications here. For example, after passing the Flexibility Act, we don't have a new forgiveness application form. Now, if you take it out now and you get PPP granted, you're automatically in the 24-week program, as opposed to previously, if you took it before the Flexibility Act passed, there may be an opportunity to make an election on whether you want it over 8 weeks or over 24 weeks. And honestly, depending on your facts and circumstances, it may make more sense to take it over 8 weeks than the 24. Because, for example, let's say you have debt covenants that are going to come due. Well, if I have it on the books as a loan, then that's debt, and maybe I'm in breach of said covenants. As opposed to if I were to do it over the 8 weeks, I take it off books, even though the forgiveness has been applied for and it hasn't theoretically been forgiven. At least it's in process, and depending on the bank and your specific set of circumstances, maybe that comes off. Again, these are just some examples. It's very variable depending on your individual business. And just because the Paycheck Protection Program's Flexibility Act has passed, by no means does that mean this is the last set of iterations of changes and facts, guidance, and guidelines we're going to see throughout the process. If this process has taught us anything, it's that this is a constantly evolving beast. We don't know exactly where it's going to go in the future, but we have a good guess as to where it's going to go in the future. And that's based upon how we've handled things from day one. Before they made the changes, we have been very consistent and we've been very accurate in our projections as to what's going to happen. Not the least of which is when there's an ambiguity in the statute, which is what we look at. We always look at the statute as opposed to necessarily everything else that's out there. And you may read and hear things from other people, but I assure you that if you actually read the statutes and have the right mindset as to how to read these things, you're going to be ahead of the game. What's an example of that? An example of that is how they said trailing 12 months in the original act. And they took that into account because the original form that came out when you applied for PPP limited you to the 2019 calendar year, which may or may not be more favorable than the trailing 12 months. We told everyone that we would calculate it both ways. We did, and we would take whichever was higher. Well, lo and behold, subsequent to our interpretation and handling of that, the SBA amended their form and noted that you could elect either time period. Another example is how SBA came out with certain guidance, and I'm not saying that guidance isn't helpful because you can certainly rely on it, but it's not outcome determinative. What do you mean? Well, they said that if you were involved in illegal gambling, you would not be eligible for PPP. We had our clients apply regardless, with the understanding that we may have to repay the money if it were deemed non-forgivable. Clarification came out because there was no statutory prohibition on lending to legal gambling facility. Obviously, if you're earning money in an illegal manner, you're not going to be eligible for PPP. So, you know, people have gotten creative over the years, but that's not what we're here to do. I'm sure everyone has seen that there were large litigation in, I believe it was Michigan, wherein a strip club owner challenged that he was not able to receive PPP funding because SBA stated that any materials of a sexually prurient nature would be prohibited from applying for funds in a footnote within the SBA's own directory. Well, guess what? Strip clubs are now eligible for PPP funding. That's why it's very important that you keep track of this and you keep track of it on a day-to-day basis. And you really need someone who's doing that because otherwise we're just seeing a lot of bad guidance out there. Another large change that benefited everyone, especially our clients down at the shore, is the extension of time in what defines a seasonal business. Previously, a seasonal business was from February 15th to June 30th, 2019. Well, they expanded it to September 15th, 2019. What does that do? If I'm a restaurant down at the shore, now I get my entire summer where I make the bulk of my money. I have seen adjustments and we've made amendments for 3 to 5 times the amount of their original loan. I'm not saying that's going to apply to everyone, but it certainly applies to a lot of restaurants because of their seasonal nature. Now, can I make an amendment to a PPP application if I've already received funding? The answer is it varies. You're going to have to contact your attorney or a bank, probably both, to get an amendment at this point in time. There are prohibitions after a loan has been out for a certain amount of time to getting the amendment. Now, are there ways around that? Yes, but it's very fact and circumstance intensive. I keep harping on fact and circumstance intensive because we have had people in the past go out, try to do this on their own, and it just results in much larger legal bills and more difficulty in getting the amendment. But to date, I have not received, there hasn't been a single one that I can think of that we failed to get the amendment as long as they came to us at the outset and we did it timely. So I'm saying there is hope. If you already have your PPP funding and you realize I could have gotten more, I should have gotten more, that's still possible in a very narrow set of circumstances. Well, what do you mean? I mean that some of the clients I represented said, there's no way I can spend all this money within the 8 weeks. So I was entitled to $1.2 million. And again, this is a hypothetical, but I'm only taking $500,000 because in the regular due course of my business, I think I can spend $500,000. Well, now that it's 24 weeks as opposed to 8 weeks, I bet they wish they had that $700,000 to spend. It's a really drastic difference. So these are a wide variety of the issues that we're seeing. People also frequently have been asking me what happens in the event that I don't have enough employees. Well, Safe Harbor was extended until December 31st of this year. What's that mean? It means that I have that much time to bring people back. Now, again, look, the application, based on what we have, is a little different than what we're going to have in the future. And especially if you're an owner-operator of a business, there are special rules that apply to you that I personally do not think are going to necessarily stand in the long term, but we have to take the world as it is today and the forgiveness form as it is today until somebody else litigates it or they come to their senses. What's an example of this? There's a complex mathematical formula, but assume that you are a business that pays $3 million over, you have a $3 million PPP loan, but the owner didn't take a single dollar last year because you were actually operating at a loss. You may have great receivables and everything else, but you had to dip into cash reserves. Owners independently wealthy or just wants to see their business succeed did not pay themselves out. Well, if you didn't pay yourself last year, you can't pay yourself this year and get forgiveness. Unintended consequences are going to happen when you rush legislation through. Are there ways around this? In very limited sets of circumstances, we may be able to do something for you. Okay, now I know that I am running up on my time frame and my time limit. I'm going to address some of the questions that came in prior to the webinar. And if anyone has questions during the webinar, I'm going to look and see exactly what we are seeing. So one of the first questions I have is, have any of the new operating expenses been added to forgiveness, such as PPE equipment? And by PPE, they're talking about masks and Purell and all that fun stuff. And the answer to that is no. It's not included in payroll at this point in time. How does this impact independent contractors who have no employees and who receive the PPP loan? Well, I'm glad you asked that. The reason I'm glad you asked that is because there's a complex mathematical formula. Guess what? If you're the sole proprietor or an independent contractor, you have one employee yourself. So you don't have to worry about the FTE requirements. What you have to worry about is how much can I actually pay myself per week? How much can I pay myself in the aggregate? And how long do I have to do it? And what makes the most sense for me? Because right now, you're not allowed to pay for, even though we're able to use it in the initial calculation, you're not able to contribute to your retirement account and have that money forgiven. Well, what am I going to do? You're going to come and you're going to figure it out with your professional. All right. Since the covered period can now be until 12/31, do we keep spending the PPP funds as needed until gone? You can. You can certainly elect to spend them over the prolonged period of time, but you're still limited in what you can spend it on. All right. Now, this is a common question and probably the number one question that I've gotten over the last 2 weeks. And that is, I received an EIDL loan in addition to my PPP loan. Do I have to give one or the other back? The answer to that is no. The EIDL loan will be used for certain expenses, and they're subject to a completely separate set of rules and regulations on what you can and cannot use the EIDL loan for. Again, it was supposed to be up to $2 million. You're supposed to get your $10,000 grant within 3 days. Eric can attest, it's taken several weeks for most of our clients to receive a $10,000 loan, and it's $1,000 per employee that's, forgivable as a grant. You can use that EIDL $10,000 grant for more things than you can use the PPP for. That is certainly true, subject to limitations. Okay. Now, what can we do with an EIDL loan and a PPP loan? Well, someone recently, and by recently I mean just now, asked me if we were able to get forgiveness for an EIDL loan. The answer to that's no. It's 3.75% over 30 years, which is very cheap money. It's 2.75%, I believe, if you're a nonprofit. But regardless, only the $10,000 grant is forgivable, and that forgiveness is deducted from your PPP forgiveness if you have both. Are sole proprietors entitled to additional money to cover 24 weeks of self-employment income? Sole proprietors are not entitled to additional money other than what they were originally entitled to. Just because we're extending the period of time does not mean that we have additional monies available to all parties. Now, I will say that there are certain strategies that you may wish to employ to maximize the amount of money that you have and how to use it. But again, it's a case-by-case basis, and it's really going to depend on the nature of your business. I've already gone over my time limit. I am going to turn this over to Eric to moderate. If you have additional questions or concerns, do not hesitate to reach out to our firm and we will be able to answer them. Again, I don't like speaking in generalities because the devil is always in the details and people misinterpret things oftentimes to their detriment.
Jarad, thank you very much. You said this, but I want to highlight it for everyone that's here. There is 20 days left. June 30th is 20 days from today. So we don't have to guess whether they're going to run out of money. Most of the people that Jarad and I have spoke to, we've said we really want to get it done tonight or we want to get it done tomorrow because we never know when they're going to run out of money. That is still a risk, but keep in mind it's 20 days and 20 days has 3 weekends in between. So you really have to do this now. If you're going to do it, this is not something, well, you know what, I'll look at it over the weekend and next week, maybe I'll see if I can find my accountant. And before you know it, the 20 days is gone. So please do something as quickly as you can if this is of interest to you. And free money, I don't know about anybody else, is of a great deal of interest to me. The next topic comes from one of our departmental meetings where Will Rubley, who's going to speak next, said, okay, well, the PPP is over, the riot's over, season's over. What do we do next? You know, he's been representing for 16 years small businesses. He's a kid because I've only been representing them for 40 years. And we all know when Labor Day comes, it usually rains. It's usually an okay Labor Day in the normal circumstances. But with our shortened season and our 25% or 50% occupancy, you can only eat outside, you can only do this, that, the other. It's going to be a really bad fall, an even worse winter, and getting everybody open and up and running for next season in the spring is going to be very, very challenging. There are going to be a lot of what I call technical defaults with your lenders, technical defaults with your landlords. There's going to be problems with your seafood people, problems with your liquor vendors, problems like we've never, ever had before. What do you do? What do you do? Well, we're going to answer that question for you. But I will tell you, having been doing this since 1981, the number one thing that you need to do, and I've represented a lot of banks and a lot of small businesses, is communicate. Communicate. Humanize. Make it, don't wait for the bank to follow up its default letter to you with a phone call or a telemarketer. Communicate, talk. My final comment before I turn it over to Will is kind of a rosy silver lining to the circumstances we're in. If you have a bad season because they found asbestos at your hotel right before the season started, or you have a bad season because one of your employees stole all the cash you were going to use to open, you have a serious problem because your bank can foreclose, can exercise its security interest, can do a lot of things to you, and you have a problem. When everybody in town does not have sufficient income to service the bank, and everybody in town is defaulting on their mortgages and their personal guarantees, the bank has a problem. So the one silver lining of it all is like we had in 2008, 2009, and to a lesser extent in 2010. When you communicate with your bank, you're talking to somebody that's more scared than you are of what the economy is going to be. They are more receptive and interested in a workout. They are more receptive and interested in not writing off your loan or writing down your loan or treating it as bad debt than you are, because they don't want to lose their bank and they don't want to see the stock the stock price go down. So without further ado, Will, it's all you.
Thank you, Eric, and good morning, everyone. So yeah, when you get to the end of the summer and you're looking at where you are and you're looking at your books and you're trying to assess how your summer went, the next step is, what do you do then? What's your plan for the fall, for the winter, to reopen the following year? You're going to want to talk to your creditors. If you are in default or you fear that you're going to go into default at the end of the summer and over the fall period, then you're going to want to reach out and talk to your creditors as soon as possible. What creditors will be willing to talk with you? Every one of them. Like Eric said, every one of those creditors are feeling the heat, are seeing the problems out there, and they're worried about when they're going to get paid and how they're going to get paid. From banks, merchant lenders, I hope none of you have merchant lenders, but merchant lenders, landlords, vendors, taxing authorities, every one of them, it's important that you communicate with them. I've represented many banks and I've represented many small businesses. And the number one complaint I get every time from the lender, from the bank, is, why didn't you call me? Just call me and tell me what the situation is and we'll work with you. You don't want to let that call go to voicemail and not return that call. You don't want the next call to be from a debt collector. Your creditors will work with you if you communicate with them. What the creditor wants to hear most is two things: when and how. When are you going to pay me, and how are you going to pay me? The way to present this to them at the time, and every business is different, and every creditor is different, and some creditors are going to be more flexible than others. So it really is going to depend on your unique circumstances or your client's circumstances. But one of the most important things when you're presenting a plan to your creditors is that your books and records must be in order. You have to have clear and concise profit and loss statements for the summer months, for the 6 months before the summer months, if you have them. They want to see those balance sheets, and they want to see realistic projections going forward. How are you going to be able to pay them? Many times when you're dealing with a lender, you're dealing with a loan workout person. Even if that loan workout person is a nice guy, and some of them are, not all of them, some are. And even if that loan workout guy wants to work with you going forward, he still has a board that he has to go back to. He's got to sell that plan to them. So in order for you to convince him, and for him to go back, him or her to go back to the bank, to the board, the credit committee, and say, we should restructure this loan, and here's why, they're going to want to see all of your past financial statements and realistic projections going forward. And when I talk about realistic projections, one thing that I try to do on those projections is I try to be conservative. It doesn't make sense to put together a plan, a restructuring or repayment agreement or change in terms agreement that requires you to pay more than you could possibly pay in a month. If you're giving up food for a month to repay a loan, that is not a realistic plan to go forward. You're going to end up defaulting on that restructured payment. A failed plan is extremely difficult to resurrect once it's gone through. So if you get the deal, you get the restructuring, and then ultimately it fails again, you've lost a lot of credibility when you go back to that creditor and say, but I need more help now. So it's important that you put together realistic projections and a realistic plan of when and how much you can pay and how we're going to structure that going forward. So there are many different ways to restructure the debt, and there's a couple of them listed on the screen. The most common is a forbearance. A forbearance agreement is kind of just a standstill. Everybody wait, sit, hold your breath. We're not going to do anything for 6 months. Whatever payments we're doing those 6 months, they can be dealt with by restructuring the loan, including slightly higher payments for the next 6 months afterwards. You can have a balloon on the back end where whatever amount was subject to that forbearance is now a balloon payment at the end of the loan. You can term out credit lines and set those at a lower interest rate and term them out over time, much longer time than you generally have on credit. You can do loan restructuring, loan extensions and restructuring, which is essentially you just go back and sign a change in terms agreement or sign a new note and a new security agreement with higher monthly payments and extend it over a longer period of time. Oftentimes, the bank or the creditor will require something extra, something that they can go back to the board with and be comfortable with. This might take the form of additional security, security in primary residence, or security in receivables, something of that nature. They also may require personal guarantees if they didn't have it before. And then a lot of vendors often do, particularly in the restaurant groups, that you do CODs as you go forward, and then you try to restructure the payment of past due amounts over time. So there's two things that the creditor wants to hear: when and how. They're not really interested in hearing your excuses, why, what happened, why you couldn't repay it. They know. They're in the same boat as you. They want to hear specifics. They want to see a very firm and concrete plan of how you're going to repay them. And they want to make sure that you're able to do so by looking at the books and records. If your books and records are not in order, I would strongly recommend that you go to an accountant, a bookkeeper, somebody. Cooper Levenson works with a lot of different accountants and bookkeepers in South Jersey that we refer small businesses to get their books in order, so that we can come up with a plan and present it to the creditors. So some of the typical issues that I've seen in doing a lot of these debt restructurings with small businesses is, one of the big ones is, how many of your creditors do you need to agree to restructure your plan for it to work? If you are presenting a plan to your bank, in that plan you say to your bank, oh, by the way, I also owe $75,000 in taxes, and I owe my landlord another $50,000. I plan on paying my landlord $20,000 per year for the next 2.5 years on top of my regular rent. That's my plan going forward, which will free up some more cash to pay the bank, and that's how I'm going to pay the bank. Well, if your landlord doesn't agree, then your plan is going to fail. So your plan with the bank is going to fail. So one of the issues is, how do you get all of these creditors to come to the table and agree on restructuring or modifying their loans as they go forward? And what happens if one says no? You have to go back and restructure that plan. You have to get your critical creditors in line first. Go back to some of the other creditors and say, this is the best I can do. And that's one of the ways that Cooper Levenson can help you in those discussions and in putting together that plan. And then what happens if none of that works? Or if one creditor says no, and that's all you need to sink the ship, and you can no longer operate going forward? Well, you're not done yet, because through the bankruptcy process, you can put together a plan under certain bankruptcy codes that you can compel or force a creditor to accept. So I'm actually going to turn this back over to Eric to discuss those bankruptcy options. Eric and Ed, unless anybody has any specific questions for me right now. The one thing I will end with is the very same thing that Eric started with: communication. Communication with your creditors is absolutely key. They want to hear from you, even if it's just to call and say, I don't have a plan yet. I'm coming up with one. I'm working with a lawyer. I'm working with an accountant. We're going to have a plan. But communicate with them is the most important part when the summer months are over and when you're looking at putting together a plan going forward. All right, Eric?
Yes, sir. Thank you, Will. That was very, very helpful. I want to make sure that as we segue into non-consensual ways to work with your creditors, we understand leverage, because leverage is key. Communication is number one. The second thing on the list is leverage. And the things that we're going to talk about, how to get the obstinate, irrational lender, the lender who has an unrealistic expectation of what he could get through a formal proceeding. One of the things we have is we have all these the existing of these formal proceedings makes Will and my life easier when it comes to sitting down. When I sit down with a particular secured creditor or unsecured creditor, and he says, if you don't give us this, we're going to close your business down. And I say to him, well, no, you're not going to close our business down, because we have Chapter 11, which has been the club that I've been using, again, for about 40 years to get workouts to work. Yes, they like us. They tell us how important we are to the bank and how much they like us being a customer. But when they realize that their liquidation analysis as to what will happen should we go into a bankruptcy proceeding, what their recoveries will be are less than what the recoveries will be if they work with us in a workout. They usually do a workout. So one of the most important things about the involuntary proceedings are that they exist. And the Chapter 11 proceeding has existed a long time. For a long time, we've had Chapter 9, which municipalities get their leverage as well to deal with their people. We now have Chapter 12 for farmers and fishermen. Very generally speaking, a Chapter 11 allows us to put everybody in the pot, and then depending upon the rules of absolute priority, says who gets paid first. Obviously, lawyers, taxes, secured creditors, and then unsecured. We can organize a restructuring plan through a Chapter 11. And it can be involuntary, at least to the extent that if you have 2 guys, 4 guys, 6 guys that are not willing to participate, we can make them participate. You have to get certain levels of consent in order to get your plan confirmed, but it really is the maximum type of leverage that you have. Now, we don't want to do that. And if we want to do that now in 2020, we have another tool, which is called small business bankruptcy. Because the big problem with Chapter 11s are, if you're a casino and you have $1 billion worth of debt with all kinds of different levels of debt and different priorities of debt, you have to go into an 11. Even when they say a prepackaged plan, that a casino is doing a prepackaged plan, it just means they've made all their deals with their creditor classes. But in order to get, 100,000 creditors to vote in favor of a plan, you can't get them all to sign off on a letter. It's cost ineffective. Many times you'll go into an 11 that way. But what we now have, which is a weapon, it is not is single asset filings, which was a weapon for the creditors, and it was a way for the secured creditor, if you only had one asset, to cut some of your rights and to cut some of your leverage. We now have small business bankruptcy, which Ed is going to explain to us in depth, is a hell of a tool. And again, its existence will significantly help us to get you concessions outside of bankruptcy without filing the bankruptcy. So without further ado, Ed, it's all you.
All right, thanks, Eric. So like we're talking about here, this is actually interesting because this is a brand new subchapter to Chapter 11 of the Bankruptcy Code that was passed into law last August, and only took effect in February, so only a few weeks before the pandemic and everything hit. So so this is brand new. We haven't seen hardly any filings under this subchapter yet, and so you see here on the slide the list of some of the ways that distinguish it from a typical Chapter 11 that you see, like some of these high-profile bankruptcies like Hertz Rent-A-Car and things like that with billions of dollars in debt. For a small business to use the same, Chapter 11 mechanism, it's not necessarily as well suited. So this new Subchapter 5, as it's called, has a number of new features here that can make it more feasible for a small business to actually use this or use it as leverage, as we've been talking about. So the first thing you see here, the debt limits. Originally it was only about $2.7 million to qualify as a small business debtor, but with the CARES Act, that's been raised to $7.5 million. So for any businesses that use this up until March of 2021, you have that higher debt limit, and we'll see if that's extended or anything as there's new developments with Congress or things like that. As the business owner, under this subchapter, you retain your equity interest without having to pay off unsecured creditors or provide new value to the business. So that's an important distinction there from your traditional Chapter 11. Another important one is with the actual plan of reorganization. The debtor under this setup has the exclusive right to file a plan. So unlike typically where a creditor could come in with a competing plan and try to get that approved over your own plan, you have the exclusive right to file a plan, and you can try to get that plan pushed through without necessarily having all of your creditors accept it. So you see the next item there. Basically, as long as the plan you're proposing is fair and equitable, you can get that confirmed without having acceptance of all your creditors. And a couple other things, basically that it's a faster process and less expensive. So as you see there, under the new sections, required status conference just 60 days after filing, and then your plan reorganization will have to be filed within 90 days, and that's a way it's written. Seems like a firm deadline, and except for maybe extreme circumstances or something like that. So you file, you get a plan put together, and you can get that filed quickly. Hopefully get it confirmed relatively quickly. You can, as you see here, that 3 to 5 years, 36 to 60 months. You can show your disposable income, put a plan together, and then some of your debts subject to discharge if you successfully make your payments. through that. And here's another one that if you're a business owner and you've taken out a mortgage to support your business, so not a mortgage you took out to actually buy your home. It does have to be your principal residence, but if you have a mortgage like this, you are able to modify that through your plan. So that's another. Excuse me one second. There we go. And again, some of the fees there, the quarterly U.S. trustee fees that you usually owe, those have been waived for this subchapter 5. And as you can see, in most cases, you're not going to have a creditors committee to deal with, and so that will also keep your costs down. So, so these are some of the ways that it could be, again, a more realistic option for a smaller business. You see the debt limits are up. It's cheaper, it's faster, and then with the way that you have more control over the process of proposing a plan and getting that pushed through. So it's important to be familiar with these things, again, because it's brand new. It gives a small business owner some new options there, and can be an important bit of leverage as you're trying to deal with creditors, down the road. Particularly, I think we're saying this is maybe further along later in this year, if there's the fall winter. So it's important to be familiar with it and see what your options are. And
yes, and Ed, in terms of expense, I guess it would be helpful and important for everybody to understand what our alternative was. Before this, you have to do a Chapter 11. And when you do a Chapter 11, you have anywhere from a 1 to 2 year process where there's multiple steps that stakeholders get involved. And the problem is, with almost no exceptions, all of those stakeholders eat off of the same plate, meaning that they all get paid by us. If it's a bank that we're dealing with, 99 out of 100 times, the loan documents say that any fees incurred by the bank are part of your payoff. If it is a creditors committee, and that happens in most Chapter 11s, where you have a creditors committee appointed and they are representing the unsecured creditors, they hire a lawyer, they hire an appraiser, they hire an accountant, and the clock goes and runs and runs and runs and runs and runs. And as a consequence, the chances of an effective, timely restructuring of the business are significantly diminished. It is better than a Chapter 7, which is a liquidation and I give up. It is definitely better. But I don't want to give the wrong impression that you swallow the Chapter 11 pill and oh boy, everything is fine. It's really not. The clocks are running for everyone. Every time there is a negotiation between the various stakeholders, you have a conference, and the clocks, when you add up the 5 lawyers in the room, all 5 of those lawyers are effectively getting paid by the debtor who struggled and who ultimately ended up in the position that they're in. But another thing I would want to point out as well, which is part of your workout and is part of Chapter 11 and is part of small business. Why would anybody take less? And how do you determine whether you get $500, you get $100 on your $10,000 claim? It all is governed by, to a large extent, the liquidation analysis. In an informal context, Will and I would have our accountant prepare not just projections that, yes, we're going to be able to make your loan, but we would be preparing a liquidation analysis that shows if you go to war with us, here's what you get, because you're getting a sheriff sale value of our restaurant. And I don't know about anybody else on the line, but most of my restaurant clients, the equipment on a liquidation basis isn't worth anything. And if every restaurant is out there trying to get rid of their equipment at the same time, it's absolutely worth nothing. So that's part of our workout negotiations, the reality of that liquidation analysis. And then in a formal Chapter 11 proceeding, we are required to treat our creditors fairly. In order to get your plan approved, it has to be fair. But it's fair within the context of that liquidation analysis. So if your liquidation analysis says that creditors on liquidation would get 20 cents on the dollar, if I produce a plan of reorganization that pays them 40 cents on the dollar, those creditors are being treated fairly. Even though they're losing 60% of their claim, it's a better result than the other result. So I think it's really important to understand that these small business bankruptcies give us something that's not a 13 that goes too fast and costs us too much money, and gives us a tool to use to get that person who, that bank or series of stakeholders who are not afraid of the 11 because they know you're never going to put up enough money to do an 11. And now we can say, well, we don't have to do an 11. We're going to do a small business bankruptcy. The retainer for the attorney is a lot less. The chances of a committee, the chances of the stakeholders, the chances of battles, complex battles over the use of cash collateral and all kinds of other things are highly unlikely in this swift small business bankruptcy. So that's important. I'd like to conclude by telling everyone that's online that they do not have to be afraid of the virus. They do not have to be afraid of the lockdown. You're not going to lose your business. They have to get through your professionals to lose your business. We will come up with workout arrangements, or we will come up with formal resolutions, but you will not lose your business. The bankruptcy code is not to put people in jail for not paying their debts. It is not a vehicle by which creditors get paid and they can go in there and execute and levy pursuant to section so-and-so of the bankruptcy code. The bankruptcy code is designed to give you a fresh start or a restructuring start, whatever it may be, depending upon which bankruptcy we file. So we have tools. We're not afraid to use them. You will not lose your business, even if, God forbid, it rains for the 4th of July weekend, it rains for Labor Day weekend, and it rains every day in between. You will not lose your business. There are choices, there are options, there are strategic alternatives that we will employ, as I've employed for 40 years. We will protect you. We got you through 2008. We got you through 2009. We will get you through this. This will be in our rear view window before you know what hit you. Now, if we have no other questions, I think we're pretty much out of time. And if anyone is looking to reach any of us, you'll see on the screen my information. You'll see Jarad Stiles, my PPP expert. You'll see Will Rubley, who is a bankruptcy and workout expert. And you'll see Ed, who is also very good in that regard. And that's all I have. Thank you again, Michael, for allowing us to participate with the Chamber in this informative and I hope helpful presentation.
Eric, I thought it was incredibly helpful. I certainly learned a lot from today's presentation. I hope our listeners did. Again, we will be emailing this video back out. It was recorded. We'll be sending that to you in the very, very near future to get that back out. But again, as Eric and the rest of his team mentioned, you have a short period of time to apply for PPP if you haven't done it. Eric, what was that, 20 days?
20 days. It's the 30th of June.
20 days. And we've been encouraging all our members and anybody we've come in contact with to take advantage of this and get this free money. As long as you follow the restrictions, it is free money. So get it and use it. Even if it's just a couple $1,000s, it will help you. Thank you again, Cooper Levenson. Thank you again, Versudia, for all of your help today. Everybody in attendance, be well, be safe. You'll be hearing from us in the very near future. Take care, everyone. Thank you again.
Thank you. Thank you very much.